do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zada and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. This is the Financial Exchange with Chuck Zada and Mike Armstrong.
Good morning. Welcome to the Financial Exchange. Mike Armstrong, Paul Lane, and Tucker Silva with you on a Tuesday here where, once again, markets are starting the day off in the green, although they did so yesterday. We left the show around noon yesterday with markets quite positive across the board, nearing 1%, and finished yesterday with the Dow and S&P red for the afternoon, which continues the trend that we've seen since mid to late December, where the market has not been able to build on 2 days of gains in a row. But nonetheless, we open up the show today with markets, so far up across the board. And I'm going to start with, a little surprise that I wasn't planning on starting with, but Bloomberg just asked the very relevant question of, will 5% make Powell unpopular? To which I respond, I was unaware that the chairman of the Federal Reserve and his interest rate setting policy was akin to a prom king and queen competition. So there's that, Bloomberg. I'm not sure whether or not this is relevant. I am not sure that Jerome Powell cares whether or not he is popular. And I'm not really sure. I'm certain that none of the rest of us should care whether or not Jerome Powell is popular. But he's not popular to begin with. Nobody likes Jerome Powell right now. He's tanking everybody's portfolios. He's making it so you can't afford a home. I can't think of a whole lot of Federal Reserve chairs who have been popular in general. Maybe Bernanke is the most popular Fed chair that I can think of, because he was basically required to be out there and convince the American public that he was their savior and was going to prevent them from losing their homes. He didn't. I mean, everybody still lost their homes. But what an irrelevant question to start the day.
Janet Yellen was my favorite one ever. Top of my list. Just my most popular Fed president ever to hold the title. I was so distracted during that because I was wondering how long Tucker was going to run the music for, because he has a habit of almost playing full songs when he inserts the clip. So I was ready to go on 2 or 3 minutes just rattling in my head with the Prom King popularity song. But it really shows to the point of where we are in the news cycle, where we're awaiting the CPI data on Thursday. You just read a lot of the headlines today. We're sort of trying to inch our way there to fill the time between we see earnings reports on Friday from some of the big banks that we'll get into the preview for, as well as CPI data.
I'm just so stuck on this. What percentage of Americans even know who Jerome Powell is?
We said...
I mean, outside of this show and the listeners to this show, I don't know anybody that... If you asked 30 people on the streets of New York, who is Jerome Powell? I bet 1 out of 30 could name, what department he heads, what government body he heads.
Especially if you weren't asking on Wall Street.
Yeah.
You just have to make sure you're in a different part of the city.
Yeah, if you're in Wall Street, then maybe you aren't getting the correct answer there. But what a preposterous question. But nonetheless, we are starting our show off with inflation, the Federal Reserve, and where things may be going on that front. Not only because of the CPI reading, which we will be getting on Thursday, and will most certainly be moving markets no matter where it lands, but also you have all the Fed chairs speaking this week and giving their outlook on where things are going to go and how things are going and how bad inflation's going to get. And at the same time, you have some asset managers once again warning of those scenarios here. And I think, look, not going to be a surprise to anybody that's been listening to this show, but one of the key points that we have continued to make is that the bond market seemed to be pricing in the idea that inflation is going to come down way too fast, and the stock market seems to be pricing in very little possibility of a recession. And in all likelihood, both of those things can't be true at the same time.
No, they can't. And to me, the problem with the rhetoric that I see so frequently is why we continue to focus on this idea that perhaps there'll be a Fed pivot and there'll be cuts. We're just so far away from that being that shouldn't be in the purview at all. The focus should be getting inflation under control. We're anticipating, I believe, for this reading at maybe 6.5% is what we're projecting for a year-over-year figure to come out on Thursday. That's a heck of a long way away from 2%. So why we're looking forward to see, hey, gee, maybe later this year in 2023, they'll cut back and go the other direction. That's not the environment we're in. And I just don't understand why that continues to be something that people are looking forward to focusing on. The focus should be get inflation under control. And it likely seems like we're going to keep rates at this elevated level before any major changes are to be made.
So to specify my outlook on this, and probably Paul's as well from what I'm gathering here, outlook seems to be inflation's running pretty hot, showing signs of improvement, but not quite fast enough that you would say we're going to get down to 2%. Is it possible that by year end of 2023, you do have inflation getting down to, say, 2.5%? Yes, I will admit that that is possible, but in my view, the only way that that's happening is with a devastating recession with high levels of unemployment. Otherwise, my outlook would be best case scenario inflation by year end is down to, say, 4%. Is it possible that we don't go into a recession next year? Yes, or this year, 2023. Yes, also possible. But if that's the case, my suspicion is that inflation is still running around 5 or 6% because there hasn't been job loss, there hasn't been wage loss, and people are still spending a whole bunch of money.
Right.
So now, is there a small chance of a soft landing? Look, also, yes, we've talked about this. We see maybe 3 different potential scenarios here. One would be a hard landing with a recession. One would be a no landing with high inflation. And the third would be this idea of that soft, pillowy landing that everybody seems to be dreaming of that would be really nice, where unemployment doesn't budge or goes up very slightly, but wage gains die off and inflation comes down. And look, I want to live in utopia as well, but that's not traditionally how these things work. And so that's the major concern that BlackRock, Fidelity, several others are calling out here. Look, markets are pricing in this Goldilocks scenario from what we can tell, and we're unlikely to get it.
No, I mean, you're not going to see so many things need to come together perfectly for that to happen.
Never say never.
I hope it does.
I hope it does. I would feel so great if it did, and I'd be willing to sacrifice higher inflation for a low unemployment rate and no recession. I would be willing to deal with all of that, but the Fed doesn't seem to want that, right? The Fed does not seem to agree with Mike Armstrong that a 4% inflation rate would be acceptable if we were able to keep unemployment really low. They seem very driven for that 2%. And guess what? They've lost all credibility, so they can't go back on that now.
Right.
The Fed should have raised rates a lot sooner than they did. They've admitted as much. Now, we're talking about a full year into their rate hiking, not quite a full year, but a good 10 months into their rate hiking cycle, they continue to target 2% inflation.
Exactly. And from everything that you read, all the commentary, there is no indications that they are going to slow down or reverse course. Continue to hear hawkish sentiment from the Fed until we get to a point, as Mike pointed out, where everything's in fantastic shape. Would you hear differently? But we got a long way to go before we get there.
So at no point in the 2023 outlook for Fed funds rate do we see the most likely scenario getting above 5%. So the most likely scenario, the way they look at this is, what percentage likelihood is it for a rate target between X and Y? And so the most likely scenario for all of 2023 seems to be landing at 4.75 to 5%. So that's kind of the peak rate. But you can see, if you go take a look at, again, to Paul's point, later half of next year, you start seeing the most likely scenario, rates are down to 450 to 475. Rates are down to 425 to 450, implying that rates go up the beginning of this year, but then come back down towards the latter half. And we'll get into it about the commentary from the different Federal Reserve officials, but none of them seem to be predicting that. They all might have different outlooks on how high rates need to go, where they need to land, how high, but none of them seem to be implying there's economic conditions that could be brought on in 2023 that would lead to a rate cut. So let's take a break right there, and when we come back, a little bit more on the Fed and commentary coming out from some of the major voting officials. Stay tuned right here on the Financial Exchange.
Wall Street's volatility continues as the threat of a recession lingers. Breaking business news all morning long, only here on the Financial Exchange Radio Network. The United States Virgin Islands are St. Croix, St. Thomas, and St. John, and they are the perfect place for your next vacation. From the moment you arrive, you'll find yourself falling naturally in rhythm with the heartbeat of the islands. Because with perfect weather and year-round temperatures of 75 degrees, relaxation is at its finest. Enjoy their spectacular beaches, world-famous cuisine, golf, tennis, and a wide variety of water sports. The U.S. Virgin Islands is one of the most popular vacation spots in the Caribbean. So head to visitusvi.com and explore their wide variety of travel packages today. There's no money to exchange, no passport required, and best of all, no more domestic travel restrictions to enter. Paradise awaits you. Go to visitusvi.com for more information and to book your trip today. Come to America's Caribbean paradise. Visit usvi.com. That's visitusvi.com.
Veterans benefits just got a whole lot better. Whether you're about to leave the service or you've been out for decades, the PACT Act gives eligibility for VA benefits to thousands of veterans. The PACT Act is a new law that expands benefits for veterans exposed to burn pits, Agent Orange, and other toxic substances. To learn more, visit va.gov/PACT or call 1-800-MY-VA-411. If you or a loved one served this country, it's time to get the benefits you deserve.
An extended nursing home stay could deplete your savings in months if you're not prepared. Learn about the steps you need to take to protect yourself, your family, and your assets from these high costs. Get Cushing & Dolan's new guide called Long-Term Care Planning for Procrastinators. Call 866-848-5699. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Tucker Silva, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange legal quick tip of the day. And we're talking about last-minute nursing home lessons that can help save your assets. What can be done last minute to save your home and your liquid assets when one spouse is entering the nursing home?
So with a married couple, you do have more options than as a single person, but with a married couple, your home is not at risk because the community spouse living in the home is allowed to keep the home. Doesn't matter the value, as long as they're living there, it's not countable and non-lienable. They also give the healthy spouse about $135,000 to keep. It's not a lot when you think of the big picture, but all the rest of the money would be at risk, but at least a quick last-minute way of protecting all those other dollars, all over and above that $135,000, would be to basically transfer the assets, those excess assets, to the community spouse, which, by the way, is not a disqualifying transfer, so no 5-year waiting period. And then once that community spouse gets those assets, depending on their age, they can buy what is known as a Medicaid qualifying annuity. These are special annuities. They convert the excess assets into an income stream, and then it's no longer an asset keeping the community spouse over assets. Then the community spouse and the sick spouse are under assets, and they're eligible for Medicaid.
Cushing & Dolan has written a brand new guide, especially for those of you who have put off doing your planning and are now faced with a last-minute nursing home situation. Request this brand new guide from Cushing & Dolan at 866-848-5699. It's called Long-Term Care Planning for Procrastinators, 866-848-5699. Or if you prefer, you can simply go to their website, LegalExchangeShow.com, and request it there.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Wall Street Watch, a full update on the market's performance to date. Weekdays at 10:30 only here on the Financial Exchange Radio Network.
All of us at the Financial Exchange are excited about this year's DAV 5K. Save the date for Saturday, November 11th for this year's race, again to be held at Fort Independence at Castle Island. Our partnership with the Disabled American Veterans Department of Massachusetts is a cause that's near and dear to all of us. So visit dav5k.boston and make your donation today. Your gifts can sponsor a veteran's family member at summer camp, as well as veterans who are homeless or hospitalized. That's dav5k.boston.
Most likely outcome of the February 1st Fed meeting is for a 25 basis point rate hike, according to CME Group right now, a 78% likelihood of that occurring, and then a 22% likelihood of a 50 basis point rate hike. I think a lot of that's going to be dependent on what we see on Thursday from the CPI report, and then following that, the PCE report. But if you know how to read those, you're going to pretty much be able to glean what's going to happen in PCE by reading CPI. So, at the same time, Fed officials have been out there. A couple of them spoke yesterday. I think we have a few more speaking today. And nobody really rocking the boat. This is the one area where I'll say the Fed has been good this year and last year. I'm still in 2022 mode, so apologies there. Everybody's on the same exact page. Yeah, the most hawkish members, the most dovish members of the Fed all seem to be reading from the same exact playbook and communicating with the public. Which is boring, but that's kind of what you want out of the Fed and the economy at large. Is pretty boring. And everyone's seeming to confirm we see rates getting to 5%, 5.25%, maybe higher, depends on the data. And then they're going to stay there for a long period of time.
And this isn't the sexiest thing for them to say some of the time. It's just, hey, we need to give ourselves some flexibility to make changes as data comes through. And all of us as investors and people who care about the economy, you constantly want to know what's next and how things are going to play out. But to be clear, they don't really know how it's going to play out. To your point,
clearly,
Mike, they didn't just look at their projections last year. We were anticipating 0.75 of base point hike for the whole year. I think that was the number that they were looking at. So these things change really quickly. You mentioned Thursday's CPI report as another data point that they're going to use to continue to see the impact, because one of the things with this idea of, or this hope for, cutting rates after raising them, is that there's a trickle-down effect. It takes months for these rate hikes to actually make their way into the public and impact the way consumers behave, the way businesses behave. So this idea that, you're going to revert back, which I think we both have agreed during the first segment, that's not really, doesn't make any sense. But you're going to have to hold in place and sort of monitor things to see what type of impact these rates are having on the economy. And that sort of leads to this idea of gradually hiking along with 25 basis points coming up in a couple weeks here on the first.
So looking out a little bit further, let's say you're looking at the spring housing market. Interest rates are pretty relevant to you. By the May 3rd meeting, there is a 91% likelihood that rates are at least 4.75%, meaning 50 basis points higher than they are today. So I keep hearing a lot of, when speaking to individuals about, I'm looking at buying a home, I think prices are going to come down, and then maybe rates will come down with that. I got to tell you, I think prices on houses are probably going to be cheaper and more inventory this year than we're used to seeing, but I do not think mortgage rates are going to be significantly cheaper unless you're doing a buy down or one of those, who knows, an ARM or something along those lines. I think we are going to be settling in this 5% rate area and staying there for a little while. Fortunately, I do think we probably get to a point by summer of this year where the Fed isn't doing anything at these meetings. We're saying, hey, we're not doing anything new. We're staying right where we are.
I could see the mortgage rates kind of plateauing, to your point, just really staying within this, what's the national average right now? Probably 6 and change, I would guess.
6.25 to 6.5 would be my.
Obviously, when we talk about the Fed fund hikes, those are on the shorter end of the curve, but they do seem to have a trickle-down effect to the longer on the mortgage side of things. I mean, right now we got the U.S. 10-year Treasury up about 8 basis points today at 3.6%. That's also a really strong benchmark to look at from the mortgage side of things, but hard to see. You can make an upside case that they'd rise even more in terms of an increase, but that would be if inflation is out of control and the Fed realizes that more significant hikes are necessary. The other argument of them retreating back to this 3-4% level, that to me is a far cry. I just don't see any real case for that over the course of this year.
According to Bankrate.com, the peak rate that we saw was 7.25% for the national average. That was reached on November 11th of last year. Since then, we've come down to a national average of 6.52%. Again, according to Bankrate here on those rates. For whatever reason, they all pull their data from different sources because I've never seen the same two numbers
matches up, yeah.
Anywhere. Fannie Mae has a different number than Bankrate, who has a different number from Bank of America. So who the heck knows? But it's somewhere in that range. And the trend has clearly been since November. Mortgage rates have come down in spite of Fed funds rate moving up. One area that I think is of concern, might not be surprising, but is of definite concern. Around 46% of credit card holders currently do not pay off their full balance. That was according to data collected back in December. It's also up from 39% a year earlier. I'll tell you, this data here, I've criticized this approach before, but it really speaks to the legitimacy of Dave Ramsey's advice around credit cards. I don't know if you're familiar, but he is like the anti-credit card person out there. That's his flatline advice. It doesn't matter who you are, how much money you earn, what you do. Nobody should have credit cards in his view because, frankly, of numbers like this, 43% of those that were surveyed weren't aware. Those with credit card debt, were not aware of the rates associated with their credit cards.
I wanted to take a minute to talk about that, but back to the Raymond's point, I thought if he said you paid off the balances that he didn't really have a beef with.
Use a debit card.
Interesting. What about the
Get
rewards?
An emergency fund.
What about the rewards points?
He said his rule of thumb is, yeah, the rewards are great, but doesn't
mitigate the risk of taking on debt. Yeah, so I want to speak to that for a second because I've had this conversation with clients recently. It is so important for listeners out there that if you have credit card debt or if you have a home equity line of credit that you have a balance on, I just was mentioning the Fed fund rate. When those hikes take into place, that's an immediate impact on the credit card debt number, the interest that you're paying, an immediate impact typically on the home equity line of credit. It's really important to understand what interest rate you're paying because I've talked with clients recently and they're unaware, or maybe they're under the false pretenses of this is the rate cycle that we were in before, that the rate is much lower. You got to understand that. It's so important.
The home equity line, fortunately, is pretty obvious, but if you've got it on auto debit, I was speaking to somebody, like you said the other week, oh yeah, I did notice those payments were like $300 a month and suddenly they're like $500-$600. Like, yeah.
Right.
It's not a fixed rate.
All of a sudden, the calculus on borrowing at 6 or 7% on a home equity line of credit, it becomes a little bit tougher than it was previously when we were used to 3 or 4%. And then on the credit card side of things, it's gotten scary territory in terms of the numbers there, 20, 25% on some of those cards. So it's really important to keep an eye out for them and not take on these balances. I mean, they also have data in here as to the percentages. If people make more money, they typically pay them off. But that, to me, is pretty... that makes sense.
Yeah.
Anticipate.
I mean, my main takeaway from this, look, I have a credit card. I use one personally. I'll just speak to that. And, unfortunately for those carrying a balance, you're paying for my rewards points, just so we're all on the same page. Right. My 2% that's going into my kids' 529 plans or whatever it is, that's being paid for by those getting charged 20% interest on their balances. And credit cards are clearly not the right tool for a large swath of Americans.
Yeah. And when you see inflation,
it is what it is.
When you see inflation pick up, that's one of the results that you'd likely see is that more credit card balances are taken on to cover expenses.
Let's go ahead and take a quick break here. Obviously, markets remain open and so far in positive territory. We'll cover all that and more next with Wall Street Watch.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
If you're thinking of becoming a snowbird, you'll need to put together a strong financial plan to make it happen. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and if you are getting ready to retire or already there, it's important to take a closer look at your current income sources and expenses if you're trying to determine whether there's room in your budget to snowbird and remain as financially comfortable as possible. Even while you're snowbirding, you can't forget your permanent home because your overall costs can add up and you might find yourself in a difficult position when it comes to your expenses. If you'd like a copy of our brand brand new guide called Can You Afford to Snowbird? You can call us right now at 800-393-4001. Again, the name of the guide is Can You Afford to Snowbird? And it's available at 800-393-4001, or you can request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Veterans benefits just got a whole lot better. Whether you're about to leave the service or you've been out for decades, the PACT Act gives eligibility for VA benefits to thousands of veterans. The PACT Act is a new law that expands benefits for veterans exposed to burn pits, Agent Orange, and other toxic substances. To learn more, visit va.gov/PACT or call 1-800-MY-VA-411. If you or a loved one served this country, it's time to get the benefits you deserve.
An extended nursing home stay could deplete your savings in months if you're not prepared. Learn about the steps you need to take to protect yourself, your family, and your assets from these high costs. Get Cushing & Dolan's new guide called Long-Term Care Planning for Procrastinators. Call 866-848-5699. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The United States Virgin Islands are St. Croix, St. Thomas, and St. John, and they are the perfect place for your next vacation. From the moment you arrive, you'll find yourself falling naturally in rhythm with the heartbeat of the islands. Because with perfect weather and year-round temperatures of 75 degrees, relaxation is at its finest. Enjoy their spectacular beaches, world-famous cuisine, golf, tennis, and a wide variety of water sports. The U.S. Virgin Islands is one of the most popular vacation spots in the Caribbean. So head to visitusvi.com and explore their wide variety of travel packages today. There's no money to exchange, no passport required, and best of all, no more domestic travel restrictions to enter. Paradise awaits you. Go to visitusvi.com for more information and to book your trip today. Come to America's Caribbean paradise. Visit usvi.com. That's visitusvi.com.
Hi, it's Chuck and Mike from the Armstrong Advisory Group, and we have a guide available this month titled Can You Afford to Snowbird? Mike, there's a big list of different costs people have to account for if they're deciding to move to a second place for the winter. What types of things are on that list?
Yeah, certainly are. I mean, first and foremost are the obvious ones. The actual cost to go rent a place or own a second home and maintain that place throughout the year are going to be substantial, especially if you're going to a popular place during a popular period of time. If you're going to Florida from January through March, that's going to be a lot more expensive than snowbirding in Minnesota. I actually have somebody I know who spends half the year in Alaska, half the year in Minnesota. The other big considerations, though, when you are going down there, what type of vacation is this for you? A lot of people, when they go on a true vacation, they're dining out every night. If you're renting a place with a full kitchen, that might not be the case, and you could find some discounts there. Transportation, once you're in that location. Am I driving down? Am I renting a vehicle the entire time? And then what's it actually going to cost to maintain my primary residence while I am not there?
You can't just turn the heat off in the winter up here.
You cannot up here. And so you might be paying somebody to stop by the house on an occasional basis. The cost of plowing if you're not there to remove the snow on your own. So there are a lot of things that go into this that are just above and beyond the simple, can I afford the rental payment?
Our guide is titled Can You Afford to Snowbird? And there are two different ways that you can request it. First, you can call 800-393-4001. Second option, you can go to armstrongadvisory.com. That phone number again is 800-393-4001, or you can request it at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Time now for Wall Street Watch here on the Financial Exchange. A little bit of a bumpy morning out there as markets were briefly positive, but have now dipped back into negative territory and are mostly flat. Investors are reacting to a speaking appearance by Fed Chairman Jerome Powell at an event hosted by Sweden's central bank. Among several items, Powell stated this morning that price stability is the bedrock of a healthy economy. Right now, at the moment, the Dow is off by 12 points, mostly flat. S&P 500 is off by nearly 0.25% or 8 points, and the NASDAQ also off nearly 0.25% or 21 points. Russell 2000 is edging nearly 0.5% higher this morning. 10-year Treasury yield up by 8 basis points, now at 3.60%, and crude oil is flat, now at $74.64 a barrel. Bloomberg is reporting that CVS Health is exploring an acquisition of Oak Street Health. Oak Street Health, which operates primary care centers for Medicare recipients, currently has a market value of about $5.5 billion. Bloomberg noted that a deal could be struck within weeks that would value Oak Street at more than $10 billion, including debt. Citing sources familiar with the matter, talks are ongoing between the companies and could very well end with no agreement at all. Oak Street stock is surging 29% on the news, while CVS shares are off by 2%. Meanwhile, Bed Bath & Beyond revealed larger than expected quarterly losses as the struggling retailer acknowledged its turnaround plan has not achieved its goals. The company reported a negative operating cash flow of $307.6 million for the third quarter and also lost $393 million during the period, 42% larger than the loss it reported a year ago. The company's comparable store sales also sunk 32%. CEO Sue Gove said the company was working to address its deepening financial issues in a timely manner. That stock up by 18%. Boeing stock is down by 1% after the aircraft maker received a downgrade to equal weight from overweight by Morgan Stanley, noting a lack of potential upside in the stock from current levels. Norwegian Cruise Line also received a downgrade from Morgan Stanley to underweight from equal weight, noting worries over how overcapacity could negatively impact pricing power. That stock off by about 2.5% so far this morning. I'm Tucker Silva, and that's Wall Street Watch.
Paul, we were talking about hockey during the break, and I love this statistic so much or this trivia question so much that I can't help but bring it up on air. So Wayne Gretzky was the fastest player in history to score 1,000 points. 433 games. Any idea who the second most? I know you're not a hockey fan.
Gordie Howe.
Also Gretzky. He needed another 433 games to score his next 1,000 points.
Wow. Wow.
So 424 games to score his first 1,000, and then he holds the record for the next fastest 1,000 at 433, and then it goes to Lemieux for 513 games to get there. But when you try and hold records against Wayne Gretzky, nothing really compares. It's tough to compare.
Just talking puck here in the financial exchange.
Yeah,
Nothing better.
Sorry. Coinbase slashing 20% of their workforce. This is the second major round of cuts. This follows a cut earlier this summer following an 18% reduction in staff. I don't think I need to explain to our listeners what's going on in the crypto market that would maybe cause these types of layoffs, and Coinbase makes a large sum of their money based on not only how frequently people trade cryptocurrencies, which is declining based on just declining interest in the space, but also the price of those currencies, because they tend to take a percentage on some of these transactions that occur. So a lot less revenue to deal with here. Not surprising. I think we will see more of this in companies that are exposed to this sort of thing, and just across the tech space specifically. What do you anything that you have to focus on this type of cut?
This is more of a general commentary on just what we're seeing from the market and the market conditions. And I want to point out a quote that was made by the CEO, Brian Armstrong, no relation to my esteemed colleague to my left here. But
so far as you know.
Right, that's true. Every company in Silicon Valley felt like they were just focused on growth, and people were almost using their headcount number as a symbol of how much progress they were making. The focus now is on operational operational efficiency. It's a healthy thing for the ecosystem and the industry to focus more on those things. And I was talking about this point with Mark Venditti during the last week of the year on the show, is that there has been this seismic shift, Mike, where we are no longer investors or analysts focused on growth, but it is the profitability and the operational execution of companies, which should be the focus at all times. But we got in this low interest rate environment where it was all predicated on how many subscribers can you add, how many users can you add, but totally turning a blind eye to this idea that, for example, Coinbase is going to lose $500 million in adjusted EBITDA losses for the full year. Not focusing on the profitability when you have inflation, that's where the focus is now.
Yeah, look, I mean, I think there can be times where growth is what matters more than profit. Clearly,
when
and
money,
I think there can
when
be
money is cheap, right?
and I think there can be legitimate reasons for that. I think the question always has to remain, though. Okay, yeah, this is growing, but can it ever actually generate a profit?
Can that spigot be turned on? If you look at the Ubers and DoorDashes of the world that operate on such razor-thin margins, yeah, it's great. It's a phenomenal service that we love using, and many people are on the platform, but how are you going to make money as a company?
Now, the opposite, the same thing could be pointed at Amazon, by the way.
Right, and they got away with it.
Razor-thin margins, grew like crazy, and then they, developed this cloud business that was extremely profitable, and their name brand, I think, did them in that space. It's not generally a good idea to use a company like Amazon as the rule of thumb. Mm-hmm. They may be the exception to the rule, not the company that proves the rule. The interesting piece to me right now that I really should have been thinking about, but honestly wasn't, because we've been seeing all these layoffs. Layoffs in a remote environment are very strange.
Delivering the message?
So, yeah, let's say, I don't think Coinbase has a physical headquarters, so I think most of their employees are remote. But let's say you do have a physical headquarters and your employees are in, 5 days a month. Mm-hmm. Do you call your employee back in and tell them that they're being impacted by a layoff on the day that they're not scheduled to be in? That seems almost more cruel than doing it over the phone. I'm genuinely curious what is going on in these HR departments, because I don't think any of them know how to deal with this. But the standard was, okay, do the layoff on a Friday, give the person the weekend to, go through all of this and deal with it. But you would never, ever fire somebody virtually or over the phone unless there was a severe exception. But if I worked for Salesforce or Coinbase and hadn't been in the office in 3 weeks, and I randomly got called in by my boss to go sit down with them and have an in-person meeting, one, I would be very suspect of what's going on. I would suspect that I'm getting laid off ahead of time. And two, what a terrible way to do things.
This brings me back to a personal story, which it's going to take us a little off the rails here, but I had to break up with a girl, and she drove over to my place. It was a reasonable commute, but I'm a believer that you do it face to face. And this ties in before you hear a screeching halt of where we're going here. Yeah. This ties into that conversation. I do believe it should be face to face. And so after the breakup concluded, which obviously didn't go great, she's like, "Why did you drag me out here to do this? Now I have to drive all the way back. I just got here in tears." And to my point, I thought it was the right thing to do rather than having a phone call or a Zoom meeting. I felt it was better to do it face to face, no matter how bad the optics were, because I thought it would be cowardly just to do it over the phone in the instance of laying off someone.
Yeah, I'm not
Quote
sure
me on
that's,
that.
I'm not sure that holds true today. 5 years ago, or you've been married for a while, so maybe this was a little bit more than 5 years ago. I'm not sure where I would have landed.
Yeah. Wait, so how long have you been seeing her? No, I think that determines a lot, though.
It was about 6 to 9 months.
Oh, you could have sent a quick text.
Oh, my God.
6 to 9 months? That's not even a year. Come on.
Yeah.
I'm a stand-up guy. Quote me on that.
But, everything... That one is really... I don't know how HR companies are handling that sort of thing. I know how they're handling it. A lot of them are doing, a lot of them are basically announcing layoffs to the company and telling everybody, hey, you'll have an email in your inbox to let you know whether or not you've been impacted.
I don't think that's fair. You're fine with the email? If you hypothetically,
I'm not.
Okay, I think there's a conversation that needs to be had.
Yeah.
I think that. But the email is really ruthless. Neither of you guys can sit here and tell me that if you were working for a company, you'd want an email saying that you've been let go.
What's the best day of the week to be laid off?
Definitely Friday, right?
So Friday was the traditional way of thinking. Now a lot of companies are saying, hey, Wednesday is better to do it. Give them a couple days when, like...
I do it on a Monday.
You do it on Monday.
Oh, come on.
Yeah, because then they're like, hey, at least I got the rest of the week to do nothing, So
Do nothing but panic about your loss of income.
So the Wednesday logic was, hey, our HR departments, our benefits departments, our health insurers open Thursday, Friday. They'll be able to get the information they need rather than just going into the weekend and stressing over it because they can't get in touch with anybody, so you can actually ask questions. The other question that I have, and I have a firm opinion on this one, I don't really know whether it should be done in person or which day of the week it should be done, but if you are planning layoffs, announce the number and get it done with. Don't do 5% here.
Oh, sure.
Wait 30 days. Do another 7% because things haven't gone according to plan. Get it over with, and then inform your employees, hey, we had to do this. We cut as far as we needed to. Don't leave it ambiguous like, hey, we cut. I think might need to do a little more in 3 months, but we're pretty sure we're in a good place. That is not going to lead to a good
And then on
work
top of
environment
it, production or productivity goes way down because everybody's just
Everybody's
talking
looking
to
for a
each
job.
other, looking for a job
Looking
or
for a
talking
job
about who's going to
yeah.
get cut.
Right.
Yeah.
So no productivity.
Anybody
that
that has worked in an office space like that, and this was very typical of the 2007 to 2010 time frame, it was like, oh man, it's Friday. It's the third Friday of the month again. Who's going to be gone this time? And it is the worst possible environment that you can work on. So I am firmly in the camp of figure
Rip
out
the
how
Band-Aid off.
Figure out how deeply you may need to cut that deep, and then tell people, hey, we're beyond this and we're done. But yeah, weird new world we're in. Quick break. Disney news coming next.
The latest news on inflation and how the markets are reacting every morning, right here on the Financial Exchange Radio Network. An extended nursing home stay could deplete your savings in months if you're not prepared. According to Genworth, New England residents could see yearly costs of more than $200,000 by 2030. So if you haven't done your planning yet, now is the time to call Cushing & Dolan. They're experts in estate planning and asset protection, which is critical if you want to enjoy your retirement years. Get their new free guide called Long-Term Care Planning for Procrastinators. Learn about the steps you need to take to protect yourself, your family, and your assets from these high costs. If you or a loved one might need a nursing home, don't delay. Call Cushing & Dolan today at 866-848-5699 and ask for their new guide, Long-Term Care Planning for Procrastinators. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The United States Virgin Islands are St. Croix, St. Thomas, and St. John, and they are the perfect place for your next vacation. From the moment you arrive, you'll find yourself falling naturally in rhythm with the heartbeat of the islands. Because with perfect weather and year-round temperatures of 75 degrees, relaxation is at its finest. Enjoy their spectacular beaches, world-famous cuisine, golf, tennis, and a wide variety of water sports. The U.S. Virgin Islands is one of the most popular vacation spots in the Caribbean. So head to visitusvi.com and explore their wide variety of travel packages today. There's no money to exchange, no passport required, and best of all, no more domestic travel restrictions to enter. Paradise awaits you. Go to visitusvi.com for more information and to book your trip today. Come to America's Caribbean paradise. Visit usvi.com. That's visitusvi.com.
If you're thinking of becoming a snowbird, you'll need to put together a strong financial plan to make it happen. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and if you are getting ready to retire or already there, it's important to take a closer look at your current income sources and expenses if you're trying to determine whether there's room in your budget to snowbird and remain as financially comfortable as possible. Even while you're snowbirding, you can't forget your permanent home because your overall costs can add up and you might find yourself in a difficult position when it comes to your expenses. If you'd like a copy of our brand new guide called Can You Afford to Snowbird, you can call us right now at 800-393-4001. Again, the name of the guide is Can You Afford to Snowbird, and it's available at 800-393-4001, or you can request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. services.
Veterans benefits just got a whole lot better. Whether you're about to leave the service or you've been out for decades, the PACT Act gives eligibility for VA benefits to thousands of veterans. The PACT Act is a new law that expands benefits for veterans exposed to burn pits, Agent Orange, and other toxic substances. To learn more, visit va.gov/PACT or call 1-800-MY-VA-411. If you or a loved one serve this country, it's time to get the benefits you deserve.
An extended nursing home stay could deplete your savings in months if you're not prepared. Learn about the steps you need to take to protect yourself, your family, and your assets from these high costs. Get Cushing & Dolan's new guide called Long-Term Care Planning for Procrastinators. Call 866-848-5699. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Text us 617-362-1385 with your comments and questions about today's show. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. St. Croix, St. Thomas, and St. John are the perfect place for your next vacation. Enjoy first-class resorts, exquisite cuisine, perfect temperatures all year round, and fall naturally in rhythm with the heartbeat of the islands. No passport is needed, and there are no more domestic travel requirements to enter. Come to America's Caribbean Paradise. Go to visitusvi.com to book your trip. That's visitusvi.com.
Well, everyone's quite focused on the real estate market, specifically the single-family home market with rates rising, inventory being quite low. What is going to happen this spring? Are people going to list homes? What are those prices going to look like? What sort of mismatches are going to be between expectations from buyers and sellers? That's always very interesting. But at the same time, something quite rare is happening in the rental real estate market. Specifically, the pace at which rental prices are declining, at least in the fourth quarter of last year, pretty abnormal. So rents fell nationally by an average of 0.9% per month in the fourth quarter. That's compared to the average increase. 2017 to 2019, the fourth quarter decrease was half of that. In a typical year, rents grow by about 3%. So a few things about this data. There's a lot of data there. In the fourth quarter, rents seem to usually fall anyway. Something about what's going on in the fourth quarter, how the data comes out, they tend to fall. But the pace of that decline was twice that of the average prior to the pandemic. And that does say something specifically. Certainly it contributed to the lesser inflation over the last quarter. But I don't really see a significant, compelling reason that this should turn around rapidly. I suppose in your mind you could say, hey, people are priced out of the buyer's market, so they're going to move over to the apartment market, so maybe prices will get a boost there. But explain to me why that would occur now as opposed to last quarter. I don't really see it.
So you think that these declines will continue to persist into 2023 because it is seasonal that this tends to happen. And granted, like you mentioned, it was more significant than normal, but you feel that this is something that will continue into the next quarter here.
I do, mainly because of those who rent, right? So if you look at rental versus home ownership in terms of the income distribution there, we were talking about in the credit card space, right? Those who are earning less than $50,000, I think 40% of those were paying off their credit card debt on a monthly basis, whereas 2/3 were if you were earning $100,000 a year. My sense is that those earning less than $100,000 a year right now are getting squeezed a heck of a lot more than those who are earning more than $100,000 a year. And you could blame home ownership for the wealthy for part of that lack of a squeeze on the upper income folks, but where's the money going to come from for these rents to continue to go up? I just don't see how it's really possible.
I just wonder, like you mentioned, with a challenging housing market, if you do see more people pile into the rental market, your argument is very fair and valid that, hey, over the last quarter or two, we've had these elevated rates and we haven't seen the impact on the rental market. In fact, lease demand has cratered in the second half of the year. But I guess I'm a little hesitant to say that this is
the beginning of a real trend.
Right.
Yeah.
I'm not sure I can get there yet. They mentioned the dynamic shift where there's less people, in that rental market, us millennials, aging more into the housing buying market. But I'm just not sure if I can get there, that we're fully there yet. The argument made that rental demand was pulled forward during the pandemic, right after that, I don't know. None of these reasons I can really fully get behind just yet.
So the vacancy rate nationwide in December up to 5.9%. That's the highest level, but only since April of 2021. It's been rising pretty steadily, about 0.2% a month. And then, look, at the end of the day, I tend to conclude with markets are generally not going to be at the extremes, and that's what I suspect will happen here in 2023. I'm not calling for 10% declines in rental rates or anything of the sort. And Bloomberg talks about the possibility of a chaotic 2023 and 2024 where capital's drying up and multifamily developers go bankrupt, new construction plunges. I don't see that scenario. I still tend to think that overall, in this housing market in the United States, we're undersupplied, and it's going to take a long time for that to correct itself.
I agree.
And I think there's profits to be made by home builders, especially in the multifamily space. Another area where prices are falling rapidly, used vehicles, and these numbers were pretty crazy to me. But last year, the wholesale price for used vehicles down 14.9%. 14.9%. Estimates for 2023 are looking like a decline of 4.3%, according to Cox Automotive. That still, however, is an increase. So April 2020 to January of 2022, you saw an 88% rise in used vehicle pricing. A 14.9% drop is quite literally a drop in the bucket.
And that's what I was just thinking of when we were talking about the rental markets. Maybe that is part of this equation here, that prices had run up so dramatically that we're just seeing declines off of what were significant highs, or a drop in the buckets from significant increases that we saw.
We saw that in the buy market. I just don't know that we saw that in the apartment rental market.
Right. That's true.
Prices seem to go down during the pandemic. In that space.
Right. They did initially.
That's all the time we have for this hour of the Financial Exchange, but a lot more to come in the second hour. We'll get to that Disney news that I had mentioned. And also, is it time to buy a hybrid vehicle? We'll tell you about that next.
This is Tucker Silva, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange legal quick tip of the day. And today we're talking about last-minute nursing home lessons that can help save your assets. Todd, more and more people are providing in-home care for their loved ones. Is there anything a care provider can do that would be beneficial to them or the family?
So if you're already providing care for an individual at home, and more people, as you said, are in fact doing that, the best thing to do is to set up a personal care contract, right? A personal care contract is something that allows you to get paid by your family member, and as long as you report it on your income tax return and prepare a personal care contract, make sure you get an elder law lawyer to help you prepare that contract, because it's got to be done right. But if you do those two things, get the contract and provide the care and put the income on your income tax return, the transfers are non-disqualifying transfers. So even if you don't make the 5 years, those dollars that you're moving will not need to be returned, and they will be protected. Also, while you're doing that, set up the trust and get the 5-year clock started. Put some assets in, because you just never know if you're going to make it or not, and you would always want to have that 5-year clock running to protect your assets.
Cushing & Dolan has written a brand new guide, especially for those of you who have put off doing your planning and are now faced with a last-minute nursing home situation. Request this brand new guide from Cushing & Dolan. It's called Long-Term Care Planning for Procrastinators. You can call 866-848-5699, or you can simply request it from their website, legalexchangeshow.com. Once again, simply call 866-848-5699, or get it from their website at legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated.
It's easy to imagine a move to a warmer climate for just a few months each year, but you need to have a sound financial plan in place if it's going to work. If you're thinking of buying a new place in Florida, you need to be sure you can afford another down payment. Perhaps you've thought about buying and then renting to a tenant, or maybe you just want to rent a place for yourself. Regardless of which way you decide to go, having a solid financial strategy is necessary. When it comes to snowbirding, there are a lot of moving parts. In this month's new guide, titled Can You Afford to Snowbird, we'll walk you through ways to make sure you understand how to build a strong plan that can take you away from the cold. Get your free copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
For 40 years, Cancer Support Community has been a relentless ally for anyone impacted by cancer, with free services provided online and in person, with their newest location in Massachusetts. Connect with Cancer Support Community Massachusetts for free emotional support, educational resources, patient navigation, financial counseling, and more. 617-797-3391. CancerSupportMass.org. CancerSupportMass.org.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM. Concord, Boston, the Money Matters Radio Network. The United States Virgin Islands are St. Croix, St. Thomas, and St. John, and they are the perfect place for your next vacation. From the moment you arrive, you'll find yourself falling naturally in rhythm with the heartbeat of the islands. Because with perfect weather and year-round temperatures of 75 degrees, relaxation is at its finest. Enjoy their spectacular beaches, world-famous cuisine, and any one of their incredible experiences, like the Crucian Christmas Festival on St. Croix from December 11th through January 7th. Visit usvi.com and explore their wide variety of travel packages today. There's no money to exchange, no passport required, and best of all, no more domestic travel restrictions to enter. Paradise awaits you. Go to visitusvi.com for more information and to book your trip today. Come to America's Caribbean paradise. Visit usvi.com. That's visitusvi.com.
Veterans benefits just got a whole lot better. Whether you're about to leave the service or you've been out for decades, the PACT Act gives eligibility for VA benefits to thousands of veterans. The PACT Act is a new law that expands benefits for veterans exposed to burn pits, Agent Orange, and other toxic substances. To learn more, visit va.gov/PACT or call 1-800-MY-VA-411. If you or a loved one served this country, it's time to get the benefits you deserve.
An extended nursing home stay could deplete your savings in months if you're not prepared. Learn about the steps you need to take to protect yourself, your family, and your assets from these high costs. Get Cushing & Dolan's new guide called Long-Term Care Planning for Procrastinators. Call 866-848-5699. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we have a guide available this month titled Can You Afford to Snowbird? Mike, the first decision that someone needs to make if they're trying to figure out if they should move to a second place is whether or not they should be buying or renting. How do they make that decision?
Yeah, it is probably the first one once you get past the idea that you want to get out of the Northeast in the middle of winter, in the middle of January. Once you've come to that conclusion, that's the next logical step. It comes down to a number of different factors, but the tough part about buying is that there's a lot of permanence associated with it. Not that you can't reverse that decision, but if it's your first time going and trying out a new space, oftentimes renting can be the more appealing decision there when it comes to spending some time outside of your primary residence. Obviously, you're not worried about the maintenance costs and everything else associated with it. All of that having been said, there is something to owning a piece of property, knowing that it's yours and knowing that you'll be able to return to the same place over and over again. You might have the best relationship in the world with the person who is renting renting you their home for those 3 months a year. But when push comes to shove, if that person needs to sell that property and move on to a different tenant, they're going to do so. So it requires some thinking and real consideration, especially if this is your first time making the consideration to snowbird.
Our guide this month is titled, Can You Afford to Snowbird? And there are 2 ways that you can request it. First, you can call 800-393-4001. Second option, you can go and download it at armstrongadvisory.com. Either way, it doesn't cost you anything. That number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Can you afford $15,000 a month for a nursing home? If not, you need to call Cushing & Dolan and get their new guide called Long-Term Care Planning for Procrastinators. Don't let a nursing home stay clean out your savings. Call 866-848-5699. That's 866-848-5699. Or you can request it online by visiting LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zada and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends. Plus, get breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. You too can support our great American heroes by visiting financialexchangeshow.com/DAV. And now, it's time for the Financial Exchange with Chuck Zada and Mike Armstrong.
Welcome back to the Financial Exchange. Mike Armstrong, Paul Lane, and Tucker Silva with you on a Tuesday morning. This week we are waiting out here for the CPI report on Thursday, but we do have earnings season kicking off very shortly here. As always, we'll hear from financial firms, big banks first, and then following several other tech companies and the likes that tend to move markets quite a bit. But banks oftentimes looked at as the canary in the coal mine, not the cannoli in the care mine. That would be very different. Cannolis. But Wall Street has clearly braced us for a turn in earnings. Just a few months ago, you had expectations for fourth quarter earnings to be positive by a couple percentage points. We are now looking at, according to FactSet, they cut their full year 2023 earnings per share forecast by 4.4% overall, and we'll start to be getting a look into that as we go through here this most recent quarter for a lot of companies, that holiday earnings season. But that cut there in terms of the earnings forecast for 2023, it's the biggest single downgrade since 2014. Now, you might be looking at 2014 and saying, well, I mean, markets fared all right. But 2015 was a very rough year for markets for anybody that didn't recall that. It was particularly fraught. And remember, too, I mean, early 2010s was a very ugly economy.
Right.
High unemployment. You had unemployment in 2014, my guess would be somewhere around 6 to 7%. You had a lot of things going still quite poorly. The housing market was still a mess. Think about anybody who bought a home in 2014 doing just fine at this point. And so, I think a lot of pretty bad expectations have been baked in. But remember how earnings forecasts and projections work, right? Companies very much try to lower expectations ahead of their earnings call and then beat those.
Right.
In fact, I think on average, companies beat their earnings forecast 78% of the time or something along those lines. So it's a pretty high beat ratio. If you have earnings actually come in as poor as they're being forecast right now, it is very fair to say that the market might not be pricing that in.
That is one of the statistics I detest the most, is that the 78%.
Oh, it's all a game.
It's so frequent. And when I was new in the industry, I was looking at, oh, geez, this is fantastic, more than 70% beat. But then you see it every single quarter, and
it's just a game.
It loses its merit. But one of the potential, catalyst risks on the downside this year, obviously inflation is the number one, but behind that is, when you look at the market, valuations and price to earnings ratio are based on earnings. And if we have significant downgrades or significant revisions on earnings, that impacts the overall valuation on the market, which is already on the higher end of things. So this could be a potential concern if we see some weak reports coming out for Q4 here being reported in the next week or so. And as you mentioned, Mike, JP Morgan, Wells Fargo, Bank of America on Friday, they start the earnings season. So it'll be interesting to see what they come out with in terms of earnings data there.
It's why I hate to look at or listen to articles and market commentaries who say, oh, well, market's already pricing in this, that, or the other. Well, were they pricing in 4.5% interest rate increases in 2022? Certainly not. Mm-hmm. And today, look, I mean, we just talked about earlier in the show how markets seem to be pricing in the idea of rate cuts in 2023, and that's pushing up equity markets a little bit here, and bond markets are being impacted by that. Likewise, forward price to earnings ratios, they're slightly cheaper than where they were before, but look where interest rates are. Mm-hmm. They're slightly above where they were when interest rates were at 0, and now interest rates are at 4.5%. Should companies be, should the price of my stock as a company, if I'm producing the same amount of profit for that price, be as expensive as it was when, the best CD rate an investor could get was 1%?
No.
I don't think so.
Right.
I mean, just my personal perspective on that doesn't seem to make a whole lot of sense. So bank earnings will come up first, and for a few reasons they're looked at as that canary in the coal mine. Big banks will have their investment bank arm. So Goldman Sachs, for instance, announced that they're doing some fairly hefty layoffs. They're laying off, I think, 3,500 or so employees out of their 49,000 person workforce. I think a lot of that is based on the fact that, hey, we haven't seen a whole lot of companies going public or needing our financing arm, and thereby we're letting some of those folks go. Likewise, Goldman Sachs is an interesting example because they also had a foray into retail banking that did not go so well, so that could be part of it as well. But we'll be hearing this from the banks and exactly their outlook on the economy. They're not always right. Banks took huge loss provisions going into the pandemic that ended up not being necessary because of all the stimulus aid, but they tend to speak pretty loudly about where they view the economy going.
If you look at the revenue pie of some of these banks, lending, obviously that's one really critical cog. That's going to be weaker, you'd think, from the mortgage demand. We've talked about the higher rates there. Then on net interest margin, that's an area where you will see.
Explain net interest margin to the to all of us here.
You have, hypothetically, let's say you have your $10,000 in a checking account at Bank of America, and many people bank there. They can lend off of the deposits on their balance sheet, and typically what they're doing is, and Bank of America is a key culprit of this, paying you no interest on the deposit that you carry on their balance sheet, but lending out against your deposit and many others to other institutions, and they're netting the difference between the two. So they're paying you 0 or 0.5%, lending out the funds to someone else at 4%. They're making that big, the difference in between. That
wasn't a whole lot when mortgage rates were going for 3%.
No, it wasn't. But now it's an area where there's now competition where people have wised up and said, gee, why am I keeping my cash here if I'm getting no interest? However, it's still a very sticky spot, and we've talked about this before, that you're less likely to change your banking around entirely, so they're still able to make more revenue there because there's this wide gap between what the Fed fund rate is at 4.25% versus where you're getting interest on your deposits 0 or 0.5% in some places. That will be strong. Trading revenue should be boosted as well with some of the volatility here, but investment banking, like you alluded to, that should be incredibly weak. We are not seeing the IPOs or any type of merger activity that we saw in 2021. It's just not going to be the case there.
Dried up quite a bit. We're going to take a quick break here. When we come back, Dan Griggs is joining us. He's the regional president of Oceanfirst Bank, Boston. Cautiously optimistic about 2023. We're going to test some of those assumptions. Are we in for a soft landing? What's his likelihood personally of us seeing that? And what does it all mean for you, the investor? Stay tuned right here next on the Financial Exchange.
This is your home for the most comprehensive coverage of the economy and the trends on Wall Street. This is the Financial Exchange Radio Network.
If you're thinking of becoming a snowbird, you'll need to put together a strong financial plan to make it happen. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and if you are getting ready to retire or already there, it's important to take a closer look at your current income sources and expenses if you're trying to determine whether there's room in your budget to snowbird and remain as financially comfortable as possible. Even while you're snowbirding, you can't forget your permanent home because your overall costs can add up and you might find yourself in a difficult position when it comes to your expenses. If you'd like a copy of our brand new guide called Can You Afford to Snowbird, you can call us right now at 800-393-4001. Again, the name of the guide is Can You Afford to Snowbird, and it's available at 800-393-4001, or you can request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The United States Virgin Islands are St. Croix, St. Thomas, and St. John, and they are the perfect place for your next vacation. From the moment you arrive, you'll find yourself falling naturally in rhythm with the heartbeat of the islands. Because with perfect weather and year-round temperatures of 75 degrees, relaxation is at its finest. Enjoy their spectacular beaches, world-famous cuisine, golf, tennis, and a wide variety of water sports. The U.S. Virgin Islands is one of the most popular vacation spots in the Caribbean. So head to visitusvi.com and explore their wide variety of travel packages today. There's no money to exchange, no passport required, and best of all, no more domestic travel restrictions to enter. Paradise awaits you. Go to visitusvi.com for more information and to book your trip today. Come to America's Caribbean paradise. Visit usvi.com. That's visitusvi.com. You've worked hard to achieve wealth and prosperity. Don't let an unexpected nursing home stay take it all away. According to Genworth, the average monthly cost for a private room in New England could increase by up to 25% by 2030. If you or a loved one might need nursing home care in the near future, and you're not prepared to handle these kinds of costs, you need to call the experts at Cushing & Dolan and get their new guide called Long-Term Care Planning for Procrastinators. In it, you'll learn strategies that can help you protect your assets that you've worked a lifetime to attain. Don't put off today what you might really need to do tomorrow. Call Cushing & Dolan right now at 866-848-5699 and get your free guide called Long-Term Care Planning for Procrastinators. That's 866-848-5699. Or you can request it online by visiting LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and our Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Veterans benefits just got a whole lot better. Whether you're about to leave the service or you've been out for decades, the PACT Act gives eligibility for VA benefits to thousands of veterans. The PACT Act is a new law that expands benefits for veterans exposed to burn pits, Agent Orange, and other toxic substances. To learn more, visit va.gov/PACT or call 1-800-MY-VA-411. If you or a loved one served this country, it's time to get the benefits you deserve.
An extended nursing home stay could deplete your savings in months if you're not prepared. Learn about the steps you need to take to protect yourself, your family, and your assets from these high costs. Get Cushing & Dolan's new guide called Long-Term Care Planning for Procrastinators. Call 866-848-5699. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and our Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Supply chains continue to be stressed and investors remain concerned. We'll continue to follow all the breaking news as it happens, only here on the Financial Exchange Radio Network.
Financial Exchange is proudly partnered with VA New England. If you or a loved one serve this country, get the health benefits you earned and deserve. Call 844-VA-CARES. That's 844-VA-CARES.
Joining us now is Dan Griggs. He's the regional president of Oceanfirst Bank and joins us to talk about his outlook on 2023 and where things are headed in a honestly just pretty uncertain time. A lot of different analysts pointing towards different potential outcomes for 2023. So, Dan, appreciate you coming on. Thank you.
Good morning, Mike. Glad to be back.
So let's start with the optimism, because I could use a little optimism in my life at this point. What would you point to for 2023, or data points from 2022 that could point towards a soft landing or an optimistic economic outlook for this year?
When I talked to you before the holiday, I talked about the banking industry and that we were optimistic for 2023 given jobs. And while the job growth is moderating, it's still strong.
Oh, yeah. I mean,
So
200
that
some
gives
odd
them
thousand
the
jobs
optimism.
created in the month of December. That's pretty fantastic.
Yep. And then inflation's cooling. So that's something to keep an eye on, particularly with the Fed. They have a benchmark historically of around 2%. So it's still pretty high at around 7%. But then a couple other things. Gas prices have gone down, and real wages have gone up. Now, in an earlier segment, you were talking about rents going down and car prices going down. That's more money in the consumer's pocket.
It is.
So that adds to our optimism as well.
What are you seeing in terms of loan demand? Obviously, rates have skyrocketed in 2022, and perhaps not in historical context. 6.5% on a 30-year mortgage is not historically damaging, but in terms of the pace of change, what has that done, in your view, to loan demand from individuals, businesses, institutions, et cetera?
I think you hit the nail on the head that historically rates are okay. While they've spiked a lot given their historic lows, it's still okay. We're seeing it differently in two different segments. For business loans, there's still demand. As long as revenues, the businesses are generating revenue, they're borrowing and need to borrow, particularly for CapEx. In the commercial investment space, that has certainly slowed down, and the returns to the developers won't be as great as they historically have been, given the rates have gone up.
Do you have an outlook for this spring's housing market? I think it's being looked at with a lot of anticipation. I keep hearing this narrative that folks feel, hey, rates might be dropping sometime in the near future. I'm going to wait for that to happen. I'm not sure I see it. Do you have any outlook on what might see this spring?
Yeah, I'm kind of with you on the rates, Mike. I don't think they're going to drop anytime soon. What we're looking at is a bumpy first half of the year with the change in Washington, certainly global political with Ukraine, but looking for stabilization in the second half of the year. So that's where we're more positive, is the second half of the year, Mike.
In my view, when it comes to this economy, I see, three potential paths with obviously a whole lot of black swan events and unexpected things that'll happen in between. But, there's clearly the most desired path of the soft landing, where inflation comes down and moderates. We don't head into recession. There's the path of, hey, inflation moderating, but recession being reached. And then there's, I think, the path of, no recession, but inflation not really moderating, and those savings that people see from things like used cars and gas prices being lower going towards plane tickets and just driving inflation higher. Do you have a most likely path, or are you seeing one that I'm not maybe considering at this stage?
No, not seeing one you don't consider. I think the middle one was the more likely in what we view.
So a recession
and you hit
followed
on
by moderating inflation.
Yep. Correct. And you hit on two key things in a prior segment, too, is the December Consumer Price Index is coming out Thursday, and earnings season's kicking off in earnest on Friday. So those two things are really going to, I think, lead us into where we go in the first half of this year.
Does your bank, or do you have any projections personally about year-end inflation numbers and year-end unemployment numbers?
6.5 is kind of what the market is targeting for inflation. So I think if it's below that, it will act favorably. If it's above that, then it won't act favorably.
Fair enough. Dan Griggs, regional president from Oceanfirst Bank, on his outlook for 2023 and hopefully some reasons to be optimistic as we head into the new year. Dan, thanks for joining us. Appreciate it, and talk to you soon.
Thank you.
Yeah, I don't look, nobody's willing to go out there, I think, and paint a picture of a really robust 2023. I think, Dan, even in his view, said, look, most likely outcome here seems to be moderating inflation, but with a recession. I think the real question is, what does that recession become? What does it look like once it's well and good for us to talk about how strong the economy is right now. Unemployment's super low. New jobs are being added. Once job loss starts to pile up, it does just that. It piles up, right? I mean, it's a very difficult thing to control. The Fed does not have any sort of tool out there to say, hey, we're going to hit 4% unemployment, and then this is how we're going to solve all of our problems. It tends to develop into its own problems. And so I don't know where things go in 2023, but I tend to be with Dan that I do think inflation is not going to be the most prevalent concern for this year. But because of that, I think the jobs are probably the most prevalent concern of 2023.
Oh, I still think inflation is the runaway leader.
Okay, well, there you go.
Agree to disagree.
The holiday discounts seem to be continuing into 2023, Paul.
Yeah, what we've seen here is a lot of retailers, Mike, have excess inventory, and we're seeing steep discounts on a lot of different clothing items. One in particular, Lululemon, really took it on the chin. Their stock earlier this week mentioning that their gross margin will drop by 1%, and it was supposed to increase, so that was significant, as well as Macy's basically stating that they are going to be on the low end of their Q4 sales numbers. It seems as if there's just not the same sort of appetite for clothing spend. We've seen 10 straight months of apparel sales decline. So what you're seeing is, as a result of that, really steep discounts. In fact, Walmart 40% off on treadmills. I might actually start looking to see what some of those prices are.
When I see it, Paul. But yeah, the demand apparently for bedroom and bath furniture also not doing terribly well. Apparently, I don't know what else they sell at Bed Bath and Beyond. I don't know what's in that Beyond section, but it looks like any of it is likely to be no more in the near future.
And I'm sure Tucker's favorite company, Kohl's, is probably taken on the chin as well.
I mean, honestly, you heard it here first. Like, we were covering these stories pretty early on in the holiday shopping season. I remember distinctly the one that sticks with me the most, and I don't know how Dick's Sporting Goods did this holiday season, but I remember listening to an interview with, I believe, their CEO during earnings season. They're like, it's been a real change of pace for us. You know, we've had a really great holiday season. We've been fully stocked on the shelves. You can come on down, and, we're not out of inventory. I'm like, okay, so you're putting positive spin on the fact that you haven't been selling anything. Is that what I'm hearing? And specifically, I remember him or her talking about the apparel piece, and that seems to be the play out in a few of these companies. I suspect that Bed Bath & Beyond is not going to be the only retailer we hear from, the only major retailer that we hear from looking at restructuring in 2023 and beyond. Rates have moved high, so any of that outstanding debt that you need to refinance is going to be more costly. And there's just a big shift right now in terms of where consumers are willing to spend their money.
Well, I was just about to ask you that. You really think, and this is what we've read, is that goods and services, or much more the service side of things, that's where the spending has been directed, less so the apparel and goods. It seems like that's been the shift.
Yeah. Now, I mean, if you survive this, I think that the retailers have now realized this and they're prepared for it. Going into 2022, I don't think they were prepared for the shift. Going into 2023, I think they've got their eyes wide open. Like, okay, yeah, that demand that we saw in 2020 and 2021, that's gone. This is the new normal. People are going for experiences over stuff. So I think they're fine for 2023. The problem is, can you get there?
Right.
If you were so oversupplied for the holiday shopping season, there are companies like Bed Bath & Beyond who didn't have good sales, who are just going to struggle to refinance and keep themselves a going concern.
No question.
3 reasons from MarketWatch why this is the year to buy a hybrid vehicle, and 2 reasons it's not. We've been a little bit obsessed with hybrid vehicles, I'll come to admit, here on the Financial Exchange recently. But honestly, I do find it pretty compelling at this stage of the game as to why that should be my next vehicle purchase. And granted, I did just purchase a vehicle and did not go with a hybrid, but the more I continue to read about these, especially for my next big family car that I'm using for everyday driving with my kids around town, plus those long haul trips, which right now is my minivan. Mm-hmm. My minivan just did a big old trip out to Chicago and back. And
you drove that?
Oh, every year, baby.
Wow.
Yeah, into 3 storms.
Yeah, but we survived. We made it. But the point on the hybrids is, one, I mean, technology, unlike perhaps the debate around EVs, the tech on hybrids tested. The first one came out in 99. 2, the selection, it's not just Priuses anymore. That was a period of time, right? Early 2000s, you wanted a hybrid, you were driving an ugly old Prius that could not make it up a slight incline. Today, they've got the Toyota Sienna in hybrids, so I mean everybody can get into one of those. And then the resale value they point out. I would debate that. I'm not sure how these batteries are going to hold up 10 years from now, but we will see. The contrary argument would be it's a pretty bad time to buy just about any car, so used vehicle, hybrid or not, who cares? Quick break, trivia up next.
You've worked hard to achieve wealth and prosperity. Don't let an unexpected nursing home stay take it all away. According to Genworth, the average monthly cost for a private room in New England could increase by up to 25% by 2030. If you or a loved one might need nursing home care in the near future, and you're not prepared to handle these kinds of costs, you need to call the experts at Cushing & Dolan and get their new guide called Long-Term Care Planning for Procrastinators. In it, you'll learn strategies that can help you protect your assets that you've worked a lifetime to attain. Don't put off today what you might really need to do tomorrow. Call Cushing & Dolan right now at 866-848-5699 and get your free guide called Long-Term Care Planning for Procrastinators. That's 866-848-5699. Or you can request it online by visiting LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The United States Virgin Islands are St. Croix, St. Thomas, and St. John, and they are the perfect place for your next vacation. From the moment you arrive, you'll find yourself falling naturally in rhythm with the heartbeat of the islands. Because with perfect weather and year-round temperatures of 75 degrees, relaxation is at its finest. Enjoy their spectacular beaches, world-famous cuisine, golf, tennis, and a wide variety of water sports. The U.S. Virgin Islands is one of the most popular vacation spots in the Caribbean. So head to visitusvi.com and explore their wide variety of travel packages today. There's no money to exchange, no passport required, and best of all, no more domestic travel restrictions to enter. Paradise awaits you. Go to visitusvi.com for more information and to book your trip today. Come to America's Caribbean paradise. Visit usvi.com. That's visitusvi.com.
If you're thinking of becoming a snowbird, you'll need to put together a strong financial plan to make it happen. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and if you are getting ready to retire or already there, it's important to take a closer look at your current income sources and expenses if you're trying to determine whether there's room in your budget to snowbird and remain as financially comfortable as possible. Even while you're snowbirding, you can't forget your permanent home because your overall costs can add up and you might find yourself in a difficult position when it comes to your expenses. If you'd like a copy of our brand new guide called Can You Afford to Snowbird, you can call us right now at 800-393-4001. Again, the name of the guide is Can You Afford to Snowbird, and it's available at 800-393-4001, or you can request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your financial exchange legal quick tip of the day. And today we're talking about last-minute nursing home lessons that can help save your assets. Todd, more and more people are providing in-home care for their loved ones. Is there anything a care provider can do that would be beneficial to them or the family?
So if you're already providing care for an individual at home, and more people, as you said, are in fact doing that, the best thing to do is to set up a personal care contract, right? A personal care contract is something that allows you to get paid by your family member, and as long as you report it on your income tax return and prepare a personal care contract, make sure you get an elder law lawyer to help you prepare that contract because it's got to be done right. But if you do those two things, get the contract and provide the care and put the income on your income tax return, the transfers are non-disqualifying transfers. So even if you don't make the 5 years, those dollars that you're moving will not need to be returned and they will be protected. Also, while you're doing that, set up the trust and get the 5-year clock started. Put some assets in because you just never know if you're going to make it or not, and you would always want to have that 5-year clock running to protect your assets.
Cushing & Dolan has written a brand new guide especially for those of you who who have put off doing your planning and are now faced with a last-minute nursing home situation. Request this brand new guide from Cushing and Dolan. It's called Long-Term Care Planning for Procrastinators. You can call 866-848-5699, or you can simply request it from their website, legalexchangeshow.com. Once again, simply call 866-848-5699, or get it from their website at legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing and Dolan. Cushing and Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Watch the show every day on Twitch TV, Facebook, and our website, financialexchangeshow.com. We're breaking down the biggest business stories of the day only on the Financial Exchange Radio Network.
In case you missed it yesterday, we welcomed the return of trivia here on the Financial Exchange. So this will be the second day in many, many weeks. So a very significant date here that we're going to touch on in trivia in terms of the entertainment industry. On January 10th, 1999, The Sopranos debuted on HBO. The Sopranos, of course, ran for 6 seasons and won 21 Emmy Awards. The show was centered around mob boss Tony Soprano and his family, as well as his struggles with mental health. So our trivia question today is, what was the name of his psychiatrist? Once again, what was the name of Tony Soprano's psychiatrist? I failed to mention that trivia is, of course, brought to you by Encore Boston Harbor. Visit EncoreBostonHarbor.com and see for yourself why Encore is a Forbes 5-star award winner for both hotel and spa. So thanks to Encore for sponsoring. Once again, what was the name of Tony Soprano's psychiatrist? Be the 5th person to text us at 617-362-1385 with the correct answer, and you'll win a Financial Exchange Show t-shirt and be registered to win a $100 gift card to Encore Boston Harbor. Be sure to include the keyword Encore in your text. Once again, the keyword is Encore, and we'll give away the Encore gift card on Friday's show. Once again, text us at 617-362-1385, and the 5th correct response will be our winner. See complete contest rules at financialexchangeshow.com.
That was going to be answered pretty quickly, I think.
I didn't know the answer to that, but I guess I
did.
Not a Sopranos trivia. You never know the answer to trivia, really?
Yeah, you can ask Ben. I nailed it.
Well, the U.S. Consumer Product Safety Commission, considering a move to regulate gas stoves and pretty much ban them. This is on the news of peer-reviewed research last month from the International Journal of Environmental Research and Public Health. I cannot say that I know a whole lot about their credibility, but nonetheless, they found that more than 12%.
Sounds official.
It does sound official. 12% of current childhood asthma cases in the United States can be attributed to gas stove use.
So many questions, Mike.
I do have a lot of questions about this as well. But if there's any inkling of truth to that, and look, it's peer-reviewed research from a scientific study, I don't really want that in my home.
Of course.
Especially if I live in like a 500-square-foot apartment. Like, I've listened to the fossil fuel bans and looked at that with a suspect eye. Like Brookline, Massachusetts is guilty of this, for instance, saying any new construction cannot have fossil fuels in the home as an energy method. So there's you build a new home in Brookline, Massachusetts, you're not getting a gas stove. Can't do it.
Okay.
You can't have a nat gas hookup. None of that stuff is allowed. I've looked at that and said, that's suspect. Let the market take care of that. If this is genuinely a safety issue, I don't know. I'm compelled to listen to it, but I also feel very, very strongly that I have no interest in an electric stove. I've used them before. I had them in my first condo. They suck.
The worst to cook with.
They're terrible.
No, nothing beats gas in terms of cooking.
Nothing. I wonder if the same thing exists. So I don't have nat gas coming into my home. So I have a giant propane tank that sits on the side of my home. Mm-hmm. I wonder, they didn't seem to have studied this as to whether or not propane causes the same degree of asthma in the home. There's a whole lot that obviously goes into this, but I suppose I could see if I live in a Brooklyn apartment that's 700 square feet with my kids, how breathing in a bunch of natural gas all day could be problematic.
That part I can see. I just wonder how often was it on in these homes, the square footage, all the specifications that I'm sure are in the details of the report, but it's hard for us to really gauge here. I mean, in this same article, they mentioned that if you just use your fan properly or that you have the ventilation on, then it's not as significant of an issue. So, I'm not so sure that I'm buying this just yet.
Yeah, doesn't seem like it. Speaking of which, have you ever cooked with induction?
No, I don't know what that is.
You got to do a little bit of research. It's pretty fascinating. So it's
like
an
an
electric
oven?
heat source. No, induction stovetop.
Okay.
You can put your hand on the burner, and it will not feel hot. It will boil your water faster than a gas burner.
What?
Yeah.
How is that possible if you put your hand on it? It's not hot.
I'm going to explain this very improperly, so I'll do a little bit of reading over the break, at which point I will try and explain how an induction stovetop works, but it's really fascinating. The downside, really expensive. You also have to buy special pots and pans that will actually work with it, so I believe it's magnetic of some sort, but that's a really cool technology, and I genuinely think that eventually could replace gas, but I'm with you. I had an electric stovetop in my first place. The thing sucked. It was terrible.
Yeah, it's just
I
like
burned everything I cooked.
Yeah, it gets too hot or it doesn't get hot enough. There's like no medium high.
Correct.
Consistency or whatever. Oh, it's the worst. The United States Virgin Islands are St. Croix, St. Thomas, and St. John, and they are the perfect place for your next vacation. From the moment you arrive, you'll find yourself falling naturally in rhythm with the heartbeat of the islands because with perfect weather and year-round temperatures of 75 degrees, relaxation is at its finest. Enjoy the spectacular beaches, world-famous cuisine, golf, tennis, and a wide variety of water sports. The U.S. Virgin Islands is one of the most popular vacation spots in the Caribbean, so head to visitusvi.com and explore their wide variety of travel packages today. There's no money to exchange, no passport required, and best of all, no more domestic travel restrictions to enter. Paradise awaits you. Go to visitusvi.com for more information and to book your trip today. Come to America's Caribbean Paradise. Visit usvi.com. That's visitusvi.com.
Frigidaire clears it right up for you here. So an electric current is passed through a coiled copper wire underneath the cooking surface. That creates a magnetic current through the cooking pan to produce heat. Because induction doesn't use a traditional outside heat source, only the elements in use will become warm due to the heat transferred from the pan.
That sounds like it's electric to me.
I'm pretty sure that it's magic.
It operates.
I just read through all that, and that seems about as magical to me as, a 50-row plane getting off the ground. So
what kind of stove is that? Magic.
Yeah, it's just a cool magic stove that I have here. Microsoft considering a $10 billion investment into ChatGPT. Anyone that has not yet heard of this ChatGPT, first of all, have you been living under a rock? Two, second of all, the technology here is absolutely fascinating, and I don't really care what you do. I think just about everyone should have the opportunity to check this out and see how it works. It is fascinating, terrifying, revolutionary. I rarely get as excited about something along these lines as I have about this AI. But for anyone unfamiliar, it is just an AI application that you can feed very simple commands to and will create a response in very human written English is the best way that I can describe that. And that can be as specific as, tell me about how this works, or, write me 1,000 words on this subject in bullet point form with 2 sentences each, and they will accomplish the objective nearly perfectly.
It's incredible, and you think of our days in high school where, write the 5-paragraph essay on To Kill a Mockingbird or whatever book out there. This can spit that out within a matter of moments. And the impressive thing about it, to your point, is it can sound so human-like. Typically, what we're used to with any kind of bot service, when you're feeding it questions, you get back computer jargon back. But
think about talking to a company over their chatbot on their website, right? That's what I was expecting. This is not that. Now, do not get me wrong. There are issues. If you ask this thing 100 questions, it's going to get some of them wrong.
Yep.
Right. If you ask them to tell you about some person, a bunch of the data could be incorrect because it's sourcing it all from the internet. The internet's just a bunch of lies.
I think, was one of the sources that they were using to feed it the information. So you got to be careful with what you're feeding it to make sure that the information is accurate. But to your point, Chuck came by my office one day and gave me a side-by-side 2 paragraphs and said, "Who do you think wrote this and who do you think did it better?" And I thought it was you and him for some sort of script they were writing. And so I just guessed, and he explained that one was ChatGPT, the other was his writing, and I picked the ChatGPT one over his because it was more concise. It was hard to discern between the two. It really was.
It's wild.
It was, I thought 2 different people wrote it.
So, like I've mentioned, this is I suspect that this technology, whether it's ChatGPT or competitors, is going to be revolutionary in a lot of key spaces, but specifically Microsoft apparently sees that opportunity as well, considering a $10 billion investment in OpenAI, which is the creator of ChatGPT. And I'm just envisioning a scenario here where I open up Microsoft Word and type in a command to ChatGPT, and it writes the entire thing. Microsoft Word has the technology built in to edit it, suggest potential problems with the design of the paper, and I don't know, just revolutionaries. How I write emails, how I draft papers, how I, if a lawyer needs to cite case law or a doctor needs to fill a prescription. I genuinely think that this is going to be practical for a lot of those things.
Yeah, as long as the information you're feeding is credible, then it is truly revolutionary. But you just have to make sure that the information is being fed properly and cautiously.
Yeah, the implications are so just completely wild to think about. But part of an MBA course, right? If you're going to get your master's in business administration, there are courses on how to write for business. Irrelevant.
Mm-hmm.
Irrelevant. Now it's only important, how do you cite sources and how do you edit documents?
It's impressive.
This could completely upend the entire way that education is taught. It's also going to create all sorts of plagiarism issues and problems for universities trying to keep up with the technology. It's just going to be chaotic for a decade until the technology is fully adopted and folded into the way that we do business. It's just such broad-ranging implications. So very interesting stuff here. Let's take a quick break. When we come back, a little stack roulette here on the Financial Exchange.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network. You've worked hard to achieve wealth and prosperity. Don't let an unexpected nursing home stay take it all away. According to Genworth, the average monthly cost for a private room in New England could increase by up to 25% by 2030. If you or a loved one might need nursing home care in the near future, and you're not prepared to handle these kinds of costs, you need to call the experts at Cushing & Dolan and get their new guide called Long-Term Care Planning for Procrastinators. In it, you'll learn strategies that can help you protect your assets that you've worked a lifetime to attain. Don't put off today what you might really need to do tomorrow. Call Cushing & Dolan right now at 866-848-5699 and get your free guide called Long-Term Care Planning for Procrastinators. That's 866-848-5699. Or you can request it online by visiting LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The United States Virgin Islands are St. Croix, St. Thomas, and St. John, and they are the perfect place for your next vacation. From the moment you arrive, you'll find yourself falling naturally in rhythm with the heartbeat of the islands. Because with perfect weather and year-round temperatures of 75 degrees, relaxation is at its finest. Enjoy their spectacular beaches, world-famous cuisine, golf, tennis, and a wide variety of water sports. The U.S. Virgin Islands is one of the most popular vacation spots in the Caribbean. So head to visitusvi.com and explore their wide variety of travel packages today. There's no money to exchange, no passport required, and best of all, no more domestic travel restrictions to enter. Paradise awaits you. Go to visitusvi.com for more information and to book your trip today. Come to America's Caribbean paradise. Visit usvi.com. That's visitusvi.com.
If you're thinking of becoming a snowbird, you'll need to put together a strong financial plan to make it happen. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and if you are getting ready to retire or already there, it's important to take a closer look at your current income sources and expenses if you're trying to determine whether there's room in your budget to snowbird and remain as financially comfortable as possible. Even while you're snowbirding, you can't forget your permanent home because your overall costs can add up and you might find yourself in a difficult position when it comes to your expenses. If you'd like a copy of our brand new guide called Can You Afford to Snowbird, you can call us right now at 800-393-4001. Again, the name of the guide is Can You Afford to Snowbird, and it's available at 800-393-4001, or you can request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Veterans benefits just got a whole lot better. Whether you're about to leave the service or you've been out for decades, the PACT Act gives eligibility for VA benefits to thousands of veterans. The PACT Act is a new law that expands benefits for veterans exposed to burn pits, Agent Orange, and other toxic substances. To learn more, visit va.gov/PACT or call 1-800-MY-VA-411. If you or a loved one served this country, it's time to get the benefits you deserve.
An extended nursing home stay could deplete your savings in months if you're not prepared. Learn about the steps you need to take to protect yourself, your family, and your assets from these high costs. Get Cushing & Dolan's new guide called Long-Term Care Planning for Procrastinators. Call 866-848-5699. That's 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Miss any of the show? You can catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon, where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network.
On January 10th, 1999, The Sopranos debuted on HBO. So we asked the trivia question, what was the name of Tony Soprano's psychiatrist? Well, that would be Dr. Melfi. Lorraine Bracco was the actress who played Dr. Melfi, and Bracco was originally offered the role of Carmela Soprano, but turned it down because she felt it was too close to her role as Karen Hill from Goodfellas. Why'd you do that, Karen? Trivia winner today was Jason from Lynn, Mass., another Lynn winner. And he is taking home that Financial Exchange Show t-shirt and is also registered to win a $100 gift card to Encore Boston Harbor, and we'll be giving that gift card away on Friday's show. Trivia is brought to you by Encore Boston Harbor. Visit EncoreBostonHarbor.com and see for yourself why Encore is a Forbes 5-star award winner for both hotel and spa.
A little bit of stack roulette here on the Financial Exchange. Paul, why don't you lead us off with what you got?
Mike, let's kick us off with a little bit of a new job opportunity for some of you college graduates out there.
Ooh.
Apply to become the official Oscar Mayer Wienermobile driver.
On. Do you need to have a college degree to be the Wienermobile driver?
I was blown. The reason I bring up this article is I was blown away by the requirements for this job. I thought it would be...
What kind of license do you need?
I thought it would be your run-of-the-mill... I thought it would be your run-of-the-mill kind of ice cream truck driver sort of resume needed. That is not the case at all. There's only 12 positions available.
Wow.
Last year, less than 1% of applicants were selected. You need to have a background in communications, know how to do brand awareness, social media, all this kind of stuff. And then, I'm not sure if this is right. This is directly from the Kraft Heinz website. Competitive salary, air quotes here, $35,600 to drive 200,000 miles over the course of the year at 200 different events. Doesn't seem like
so. I've got to drive 200,000 miles.
Yep.
That's a lot.
I've got to market Oscar Mayer wieners
to 200 different events.
But I don't need to have a special driver's license. It doesn't sound like.
I
this
doubt
thing's
it.
pretty big. I'm kind of surprised, but yeah, you're not required to have that special license.
Oh, I guess so. That's the only positive thing you could say. That is a heck of a lot of work, and you have to document the whole thing on social media. That's a lot of work and a ton of miles.
It's a resume builder, though.
Oh,
Paul.
really? Yeah, you're right to the C-suite.
Absolutely.
Right
You want to
after that.
land that social media
Hey,
director
it's a talking
job?
point, yeah.
I drove around and dressed up as an Oscar Mayer wiener for a full year. And
Do you have to dress up as an Oscar Mayer wiener? I don't think so. They have some pretty outlandish gear on, but
Okay, well, I got to use the theme colors, apparently. I don't know. Looks like quite the experience. Probably unlimited hot dogs, though.
Yeah, because that's good for you.
You'd think so. I don't know.
I'm not sure that there's much that's worse for you than an Oscar Mayer hot dog.
Yeah, I would
Or any
rank.
hot dog.
I would
Any hot
rank them
dog.
at
Yeah,
the
it's not-
bottom
it's
of
not Oscar
my
Mayer.
hierarchy of hot dogs. I don't really think they're in the top tier.
Well, staying in the food and beverage space, Pepsi. Every time one of these companies comes out with a new soda, I just can't help but talk about it. Pepsi is setting its sights on Gen Z with Starry, a Sprite competitor. It's a crisp, refreshing formula with a bite to win share and grow the category. It's a purpose-driven brand built for Gen Z, a fun escape that takes steps on sustainability. Pepsi has had several competitors to Sprite, such as Slice and Storm. None of those have really stuck with it. I think I've identified their problem. Stop naming it an S word.
Yeah, exactly.
Come up with something else here. It doesn't need to rhyme with
Fair.
Sprite in order to be a competitor of Sprite. In fact, I think the trend that I'm seeing these days towards generic brand name sodas and just products in general, I think that they should just go with a plain old retro version can called Pepsi Lemon Lime Soda. And I think that would sell like hotcakes.
Huh? You got me a little perplexed on that. I think the Sprite brand name is pretty valuable.
Because the second you say Pepsi, you think of a brown soda, so I
Yes.
don't think
Yeah.
that would work.
Yeah, no, I don't think so. I'm going Pepsi Lemon Lime Soda, and that's what they should go with.
What's making this a Gen Z hit?
Nothing.
YouTube reviews? Is
Yeah,
that
the
reason
way in
why?
which they are marketing it seems to be the primary
Yes.
driver there.
It's the new age.
Who drinks soda anymore?
Not a lot of people.
Not a lot of
Especially that generation.
Especially caffeine-free soda,
Yeah.
right.
right? Because
Right.
Sprite's caffeine-free, I think. Last time I checked, I do not believe there's caffeine in Sprite.
We'll
and
have
presumably
IT.
Starry doesn't have it either. Just a weird trend. I see
No,
a few
there's no
people around the
caffeine.
offices that will drink
what's
a
your
lot of
What's your
Coca-Cola.
favorite soda?
As a kid, so we never had soda around the house. But
Right.
as a kid, if we ever went on vacation to
Or
go
like
visit
a
my
dinner out.
grandparents out in Arizona, I would go with a Dr. Pepper.
That's mine too.
Dr. Pepper would be the
That or-
treat of my year on the occasion that flying on an airplane was the really rare opportunity that I would have to get a soda. And if sometimes I'd go to a restaurant they didn't have Dr. Pepper,
Yeah.
and I would just be belligerent.
Mug root beer also. I was a root beer guy too. Those are my two.
I would do
Tucker,
probably.
pretty judgmental on the soda front here.
I would do the Dew, probably Mountain Dew,
Okay.
or Sprite.
Get out of town. Markets are
yeah.
up, but not really moving anywhere in anticipation here, waiting on that Thursday CPI report. Dow up 12.5 points, 0.4%. S&P up slightly. NASDAQ leading the way up 0.2%. That's all the time we have for today's Financial Exchange, but we'll be back at it tomorrow, folks. See you then.
If you buy a new property, could you continue to maintain the costs of your current residence in order to become a snowbird? There may be some tax benefits to staying a bit longer in each year in a state like Florida, but if you don't have a sound financial plan, your winter may be spent watching the snow continue to fall. Hi, this is Chuck Zada from